Yeah, I love that. I mean, I think I want to come back to something to this topic that if what you're saying is true, and I happen to agree with you, which is we're in a sort of lower for longer environment, and there's going to be a premium paid on anything growthy.
Yeah,
Um, so that means that capital is going to ultimately flow towards technology companies.
yeah,
Now, but I believe both in your portfolio and in others, what we're seeing now is these massive, massive companies, trillion-dollar
yeah,
businesses that are emerging in the tech arena, and they're
yeah,
still proving to be very profitable, which contravenes conventional wisdom. I mean, I think even at Legg Mason, like after those 15 years, it got so big. I think Bill Miller struggled for a while,
yeah.
probably because of the size. And that's historically how it's been, is like funds get too big or companies get too big and their
Yeah.
growth rate kind of diminishes. Why is that? Are we not seeing that? And do you see that as being sustainable or enduring on a go forward basis?
Yeah, yeah, it's a great question, Mo. What you're pointing out is in classical economics, it's kind of like kind of death and taxes, the two things you can't avoid. In classical economics, you can't avoid diminishing returns. In the brick and mortar world, which is where GAAP accounting originated, in the brick and mortar world, you're faced with diminishing returns because at some point in time, the next unit of production that you put in place will get you a lower return. You've
Right.
saturated the market or something like that. So and diminishing returns economics, it's the rule of law, since the turn of the century. Well, I should say since 1900 to 2000. Then there was a guy named Brian Arthur at the Santa Fe Institute, and he was, on the West Coast at universities and stuff like that, that introduced the concept of increasing returns economics. Well, that's, wait a minute, that's not how the economy works. But he pointed out that when you move from brick and mortar into what's called kind of we're knowledge-based economy now, right? So knowledge-based economies are different than brick and mortar. And so you run into these networks. Networks get formed. And what you understand about networks, and this happened with Microsoft because he was a witness for the United States in their case against Microsoft in the early 2000s, was that you've got to get big fast. If you get big fast, that's your franchise, that's your
Right.
moat.
Right.
And so as more and more people join a network, and the network can be software, the network can be a whole lot of different things in technology, the network gets bigger and bigger. As it gets bigger, more people join it. As more people join it, it gets bigger. And so it keeps going. Then the thing that happens next is that in the brick and mortar world, if you get a 15 to 20% return on equity, that's huge. That's great.
Mm-hmm.
And that's pretty good money. In the tech space, because there's so little brick and mortar, and the fact that most of their intellectual capital is expensed through, and I don't want to get too far off the reservation, but the capital investments that Coca-Cola would make or General Motors would make, that doesn't run through the income statement. That is capitalized on the balance sheet and then depreciated over time. So it never impacts their earnings, right?
Right.
In technology, when you make a capital investment in knowledge, if you will, to use that, you expense it immediately in the income statement, just like pharmaceutical companies did with R&D. So your PE is automatically high and your book value is automatically low. So the classic value guys go, that's a high PE and a low book value. I'm not buying it. But the cash that came out of these things was just incredible. Now, here's the biggest part. The returns on invested capital of these network giants became 100%. Think about that. 100% return on invested capital. Dell Computer was the very first company in modern history, in all of history, to ever generate a 100% return on invested capital because it had negative working capital. It was able to do that. Today, Apple has 120% return on equity, no debt, right? What you can do with those economic returns is just phenomenal. So they're getting bigger, but they're also getting faster, and their returns are going up. And that is counterintuitive to Shelby Davis, a great investor. Chris Davis's father at Davis Funds used to say, when it gets to 50 billion, sell it because it will never get any bigger. And for a period of time, that was true. But how did Apple go from 800? I don't know what Tim Cook took over. Apple was 600 billion market cap, and then it crossed 3 trillion. At the same time, over that 10-year period, Tim Cook, because they never had a formal share repurchase program, repurchased $800 billion worth of stock. So first of all, you had to have generated the cash,
Hmm.
right, to have bought back $800 billion worth of stock, which, by the way, would be the seventh largest company in the S&P 500. And along the way, it became a $3 trillion business. Along the way, the returns on equity kept going up. Now, here's the other part, which is the sales growth is going up because now services is becoming a bigger and bigger part of the company, which is growing 5 times faster than a handset business. Is it possible that Apple at $3 trillion actually begins to pick up speed and picks up returns on capital? Absolutely, it will.
Wow.
So you look at it and you go, I've just never seen this animal before.
Hmm.
And most people would look at it from a historical context and say it's a bubble. I mean, if I hear one more time how the 7 megacaps are in a bubble, it tells me that nobody understands what they're talking about. They're not in a bubble.
Interesting.
And that when something earns 100% return on invested capital, a 30 or 40 multiple is not overvalued. It's just not. You can do the math. So that's the evolution of markets and the evolution of the agents in the market. It's a whole new species, and they've got a long way to go, and we're just getting started. I know we don't have AI on our topic, but this AI thing is not a bubble. This is not 1999. I managed money in 1999. We were basically counting eyeballs that we thought would get us cash, right? If we had eyeballs, we'd eventually get the cash through advertising or subscriptions. And that didn't work out, and that's how the market cracked.
Yeah.
Today, the dollars are going first, and they'll pick up the eyeballs later. The amount of money that's being spent in AI, if you spend time with McKinsey, Bain, Accenture, Ernst & Young, all of them, they will tell you they can't keep up with the demand of people sending them money from Fortune 5,000 companies telling me, help me figure this out, help me figure this out, help me figure this out. So this thing's got a long way to go.